Hey everyone, it's Lisa here. Now I'm with you today with some very, very important trading tips and tricks. Now I'm going to look at the portfolio breakdown. Now this is really important due to what's happened with Luna lately. So there's an old saying in crypto, never go full retard. Now this is not offensive. It comes from the movie Tropic Thunder. But basically in crypto, it means never put all your eggs in one basket. So never be full in anything. So, when you go full in something, you're going the full retard. So that's why it's a little bit offensive, because it's there to let you guys know that you should never be doing it. The reason being, something like Luna happens, you lose all your money. So you never want to do that. You want to be equally sort of spread across. So that sort of spreads your risk. And if one coin goes down, you don't lose everything. The other thing is a lot of exchanges over the years have had issues. So we've got Mt. Gox, we've got Quadriga. There was an Australian exchange that went down, a New Zealand exchange that went down. So there's been countless exchanges that have gone down as well. So you never want to have all of your crypto on one exchange, in one wallet, in one place. You want to have that spread as well. So my crypto is across 15 exchanges. So that's probably a little bit extreme. And it's in various wallets and paper wallets and so on and so forth. But when you're starting out, I do suggest you have at least 2 exchanges. 3 is better. And then have, spread your sort of exposure to all exchanges. And that way, if one exchange goes down, you don't lose all your money either. So let's jump in and have a look at this portfolio and how you should be breaking down your crypto portfolio, regardless of whether you've got $1,000 or $1 million. You should never, ever be all in one coin. So if we jump into this and we add the portfolio here, you can see that it should be broken down in a certain way. So how I like to do it is have 25% in BTC, 25% in Ethereum. I want to have at least 30% in long-term alts. Now, long-term alts probably at this point, very point in the market, is a little bit risky. But we want to be having exposure to, depending on how big your portfolio is, so that's 30%. So it should be like maybe 3 trades up to about probably 15. So if you've got a larger portfolio, 2% of that portfolio in 15 trades is going to be, quite a nice sum. And you've always got some movement on your wallet. The other thing is you want to have 20% that is actively tradable. So that 20% is, you can be in your degen coins, you can be in, some quick in and outs, you can be scalping, you can be doing all of those more riskier things. So you want to be having at least, depending on how big your portfolio is, I have about 20 trades at any given time. So that's sort of, it's recycling. So when one hits target, we move to the next. One hits target, move to the next. And it's sort of always recycling that money, and, it's always moving. So that's how you want to do it. So again, let's break that down. We want to have 25% in BTC. We want to have 25% in Ethereum. We want to have those long-term alts. We want to have 30% of our portfolio broken up into about 15 trades, maybe a little bit more. You could have, if you've got quite a large portfolio, you could be breaking that down again into maybe 30 trades and having 1.5%. But, 2% is probably the lowest that I would go with that. So that gives you 15 trades. And then you want to have your various alts, which is 20%, which is your active trading bags. So these are the ones where you're jumping in and out, jumping in and out. Long-term alts are the ones that you hold for the entire pattern. So you buy low and you sell high. Obviously, that's what we always want to do. So you want to always have a stop loss on these in case you do get it wrong. And then you're only losing a small amount. especially if something like Luna happens, then you would have had a stop loss. You would have maybe lost 10% in that, and then, continued on with the next best thing. Hopefully you weren't in UST as well, but that's what you want to do. So when you're breaking it down, make sure you follow those rules, spread your risk across, 2 to 3 different exchanges, plus also spread your risk in a various amount of coins and tokens, so that if one completely leaves the market, you're not left holding dead bags. So hope this has helped. And, this is a really important lesson for such a lot of people. And I know it's going to scare a lot of people off in the market. We don't want that to happen. The name of the game here is to make money. So this is the best way, and happy trading, guys. Thanks for watching.